welcome back. Welcome back to Leo's Lessons. I've got a very exciting lesson for you today, and a good lesson because it's about investing and maybe it'll help you avoid market bubbles. So what is a market bubble? Some of you may have heard of the dot-com crash or lived through it. The most famous, first documented asset bubble was the tulip mania bubble of the early 1600s. At its peak, tulip mania created such a frenzy that fortunes were made overnight. Key thing with market bubbles is you don't know you're in one until it bursts. Why is it called a bubble? Well, think about a soapy bubble filled with nothing but air, and the slightest touch can make it pop. Sometimes these market bubbles take years to develop, and what causes them varies. All bubbles share one thing in common, however. They eventually burst quickly and cause devastating impact. Market speculation, of course, always leads to the bubbles. It can lead to investing on mere potential, ignoring actual fundamentals, and the actions of many investors and their fear of missing out leads to these bubbles. The herd relies on instinct and feelings and emotions to make decisions, which distorts their ability to behave rationally. That's why they're called the herd. The exuberant behavior causes the bubble in the price of the asset to inflate rapidly, and it's followed by a quick decline in value or a crash. It is referred to as a bubble bursting. Well, you have stock market bubbles, which draw resources into the areas of rapid growth. And at the end of the bubble, resources are moved again. Once again, explaining the laws of economics. A dried up in demand causes the prices to fall. American economist Hyman Minsky identified 5 stages in a typical credit market cycle. The subprime mortgage crisis of 2008 renewed interest in his formulation, so it's worth going into those. The first stage he identified was called displacement. In this stage, you have investors start to notice a new paradigm, like a new product or a new technology, or historically low interest rates. Second stage is the boom. This is when prices start to rise and they gain momentum, and this is when the herd piles on. They enter the market and there's an overall sense of failing to participate or the fear of missing out. This causes even more people to start buying assets. Euphoria sets in, and when you know it's euphoria is because investors exhibit a total disregard for caution. Next stage is the profit taking. This is where the so-called smart investors know when to get out. Again, timing and anything related to asset and stock markets is near impossible. But if you're lucky enough to identify the early warning signs, you may realize above average returns. Final stage is, of course, panic. And when panic sets in, asset prices change course dramatically, and they drop as rapidly as they once rose. At this stage, investors want to liquidate their assets at any price. And so you have a quick decline caused by supply that exceeds demand. So let's go back to the tulip mania once again. It's the first recorded speculative bubble. It occurred in Holland between 1634 and 1637. The bubble started by accident. A botanist brought tulip bulbs from Constantinople and planted them for his own scientific research. Neighbors stole the bulbs and sold them to the wealthy, who collected the rare varieties as a luxury good. Some rare varieties of these tulips commanded astronomical prices. Bulbs were traded even for homes and acreage, if you can believe that. At its peak, the tulip mania had created such a frenzy that fortunes were made overnight. A futures exchange was even created for tulips. Tulips were bought and sold through contracts with no actual delivery, and this, of course, fueled further speculative pricing. The bubble finally burst when a seller arranged a big purchase with a buyer, and the buyer failed to show. At this point, it was clear that the price increases were unsustainable. The panic set in and spiraled actually through all of Europe, driving the worth of any tulip bulb down to a tiny fraction of its recent price. Dutch authorities finally stepped in to calm the panic, and they allowed contract holders to be freed from their contracts at a minuscule 10% of the contract value. Fortunes were obviously lost by nearly everyone that participated. Recent history now. Two market bubbles that I've lived through, and they're two very consequential bubbles. The dot-com bubble of the 1990s and the more recent housing bubble of 2007 and 2008. What was the dot-com bubble? Named for the companies that were the most bubble-esque or more speculative. I remember that any company with a .com in its name commanded high premiums. You had a rise in equity markets, mainly in the NASDAQ, and the chart you see there, a tech-heavy NASDAQ. Investments in internet and technology-related companies, or internet and the technology that built the internet, grew out of combination of speculative investing and an overabundance of venture capital that funded these startups. Investors started to pour money into these internet startups with the express hope that one day they would be profitable. Technology did advance and the internet became commercialized. More and more companies went into the space. The surge in the stock market followed, and the subsequent bubble was formed by cheap money, poor stock market analysis. Because why? Many of these companies didn't generate a profit or even have a significant product yet they went public. The IPOs were offered, fueling large surges of cash to the company owners. And so their stock prices saw incredible highs. And then you had the frenzy among interested investors. The market peaked, panic among the investors ensued. Capital that was once easy to obtain started to dry up. Companies with millions in market capitalization became worthless in a very short amount of time. I can attest to this because my very first investment was in one of these companies, and it evaporated within months. As the year 2001 ended, a good portion of the public .com companies had already folded. Back to the NASDAQ chart, you had a peak in the NASDAQ at over 5,000 points by March of 2000. Not nearly 2 years later, you had a market bottom of 1,100 on the NASDAQ. The U.S. housing bubble came next. As if we hadn't learned our lesson from the .com, the difference was that investors wanted something tangible. It appears they'd learned their lesson by investing in non-tangible assets, these internet companies that didn't have a product or didn't show any signs of profitability. So they went next into the housing market. What was attractive about the housing market? Again, it was a tangible asset. Lending back then became easier and easier. You used to have to put 20% down to purchase a house. That was waived. Something called ninja loans, no income, no job loans became available, and also adjustable rate mortgages became a favorite of home buyers. These adjustable rate mortgages offered low introductory rates, and then you could refinance as the price of your house went up. To use it as a piggy bank, you would refinance and cash out the equity within 3 to 5 years. So then people started even flipping these homes because the price appreciation was so rapid, you could buy a house 1 year and sell it at a profit the next year. What happened? So the stock market started to rise again, and that was followed with interest rates increasing. So again, these adjustable rate mortgages would adjust. What was once an affordable monthly payment at a lower introductory rate became an unaffordable payment at a higher rate as these adjustable rate mortgages adjusted. So what happened is the housing market prices took a nosedive, which triggered a sell-off in mortgage-backed securities. These were mortgage loans packaged by the banks, sold as investments that were safe and offered a nice interest rate. So then you have an environment that resulted in millions of dollars in mortgage defaults, which obviously hurt investors, but also caused the banks that issued them to go bankrupt. Irrational exuberance defines everything I've just discussed. That phrase was popularized by former Federal Reserve Chairman Alan Greenspan. He used it to describe the collective enthusiasm among traders and investors that fuels a rapidly increasing price, and it outstrips the underlying fundamentals. You can call it the crowd mentality, you call it herd bias, bandwagon effect, or fear of missing out. There is a self-perpetuating cycle where people want to buy an asset simply because the price is increasing and they hear other people that have made money in this asset. So you drive the price even higher. Again, more market demand, higher price. It's important to note, however, that just because something is increasing rapidly, it doesn't mean it's a bubble. You can have rapid price increases after a recession or after a bear market. What do? How do you recognize a economic bubble? How do you stay out of trouble? So one thing you could do is stick to the old, tired and true, diversified asset mix. What does that allow you to do? Well, it allows you to have many different assets so that even if one investment falters, your other investments shouldn't falter altogether. So you position yourself to minimize the risk of one asset faltering and also position yourself for longer term and steadier growth. So it's not as exciting and you don't get the stratospheric ride of the asset bubble investments, but you also don't get the extreme lows. You can also ask yourself the question why you're investing in something. Again, if you're chasing returns, if you've heard someone talk about how much money they've made in something, or you have the fear of missing out, or you feel like you're hopping on the bandwagon, if it feels like that, I urge you to use caution. And also, what is your expectation for returns? If something's already appreciated by a wide margin, do you think it can continue at that rapid pace? Will that already indicate to you that it is a market bubble as it's happening? And if you do chase a market bubble, just don't be greedy. Get out. Get out when you've made some kind of target return. As a last example, I think this one is one that it seemed to be a bubble when it was happening, and you'll quickly understand why. It was pretty easy to point out, but there was a lot of hype behind it, and this is Beyond Meat. So let's just do a quick study on that and end the lesson on market bubbles. So of course it crashed. The animal kingdom already had a 95% market share. However, in 2019, Beyond Meat went public amid massive media coverage, and its stock popped. It reached a high of $234 per share in the summer of 2019. I remember someone taking me out to lunch, and we went out to find one of these Beyond Meat burgers, and we had to go to 3 different restaurants to find one restaurant that hadn't sold out of them yet. But Beyond Meat had partnerships, distribution deals, grocery chains, fast food restaurants, all kinds of products. They had, their beef jerky. McDonald's offered them a plant, beefy crumbles at Walmart. So they were everywhere, just like that, basically overnight. The question, though, that should have been asked by the investors, the cheerleaders, and the financial analysts that propped up the stock is, who is going to eat this? Again, recent studies point that vegetarians make up about 5% of the market, meaning 95% of the rest of us are meat eaters. So if there's only 5% that your market share is, you obviously want some of the 95% of the meat eaters to convert to eating a vegetarian product. But starting with the vegetarians, would they be your target market if they consider themselves vegetarian? Are they going to eat something that reminds them of, the charred cow flesh that they're trying to avoid? Probably not. And is a vegetable patty a substitute for a burger for a meat eater? So that's the lesson. It's important to ask yourself simple questions. Who's going to buy this? Who's going to eat this? What's the target market? Don't fall into the wishful thinking or the media hype. And when you hear it's the future, that's already a warning sign. And again, always go by the laws of supply and demand. That will tend to keep you out of investing in market bubbles. Thank you for joining me today. I hope you found some of that to be interesting. And stay invested, stay diversified, and don't chase market bubbles. Thank you again. I appreciate your time.